Hi, everyone. Before we dive in, please remember that this video is for educational and entertainment purposes only. Always seek advice from an investment professional before making any financial decisions. Welcome back to the channel. Today, we're going to talk about U.S. government bonds, what they are, and how they work. Whether you're just starting out in investing or simply curious about how bonds differ from stocks, this video is for you. So, what exactly is a bond? In simple terms, a bond is a loan. When you buy a U.S. government bond, you're lending money to the government. In return, they promise to pay you back the full amount on a specific date in the future. Meanwhile, they'll pay you interest, usually every 6 months. Think of it like this. If you lend money to a friend and they agree to pay you back with interest, that's similar to how bonds work. You're the lender, and the government is your borrower. Now, you might be wondering how bonds differ from stocks. Let's break it down. Bonds. As we said, bonds are loans. When you buy a bond, you're lending money and expect to get it back with interest. You don't own part of the company or the government when you buy a bond. Stocks. On the other hand, stocks represent ownership. When you buy a stock, you're purchasing a small piece of a company. If the company does well, your stock value might go up and you can sell it for a profit. But if the company does poorly, you could lose money. Unlike bonds, stocks don't guarantee any payments or returns. So, in summary, bonds are loans and stocks are ownership. Before we continue, if you're enjoying this video so far, make sure to hit the like button, subscribe to the channel, and ring the notification bell so you never miss out on future content. Now, let's talk about how interest rates play a role in the bond market. When you buy a bond, it pays a fixed interest rate, also known as a coupon rate. But what happens when overall interest rates in the economy change? If interest rates go up, new bonds will be issued at higher rates, making older bonds with lower rates less attractive. That means if you wanted to sell your bond before its maturity date, you might have to sell it for less than you paid. On the flip side, if interest rates go down, your bond with a higher rate becomes more valuable, and you might be able to sell it for more. So, the relationship is simple. When interest rates rise, bond prices tend to fall, and when interest rates fall, bond prices tend to rise. One of the main reasons people buy bonds is to earn regular interest payments. These payments, called coupons, are usually made twice a year. So, if you own a bond that pays 2% annual interest on a $1,000 bond, you'll receive $20 per year, typically split into two $10 payments every 6 months. This regular income can be appealing, especially for people looking for stable and predictable returns. Finally, let's talk about when you get your full amount back. This is called the maturity date. U.S. government bonds have different maturity dates, which can range from a few months to 30 years. When the bond reaches maturity, the government pays you back the full amount of the bond, also known as the face value or principal. So, if you bought a bond for $1,000 at maturity, you'd get your $1,000 back, plus all the interest payments you earned along the way. To recap, U.S. government bonds are loans that you give to the government in exchange for regular interest payments and the promise to get your money back at a future date. They're different from stocks, which represent ownership in a company, and bonds are generally considered safer investments because of the steady interest payments and the government's backing. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss out on future content. And remember, always consult with a financial professional before making any investment decisions. See you next time.